Good morning, everyone. Good morning. It is so good to see you all this beautiful and amazing Monday morning here in Austin, Texas. It is so good to see you all. We have a lot to go over this morning. It's going to be a very exciting week for the market, but it's always exciting. Such a good mood, you all. I am in an amazing mood. Happy to be back to good old Austin. Flew in last night from the beautiful city of Chicago. It was nice and chilly, but it was beautiful. I love Chicago in the winter. It is magical and fantastic. So really excited to be back. Thankfully, I was able to change my flight to an earlier flight. I wasn't supposed to get in until 1:55 a.m., but thankfully got in at 8:30 p.m., so I'm very grateful for that. It is so good to see you all. Lots to go over. You know the point. Monday Morning Touch Point is where we do a very thorough and complete analysis of the market, including what is known as the single best leading market indicator available, the new listing to pending ratio. Let's take a look at what's going on. Let's take a look at what's happening with the market. Have you all noticed the headlines changing for national real estate? Have you noticed a shift in headlines, or is it just me? Yeah, okay, we've got Ryan saying yes. We've got a few more people right there saying yes. That's what's happening. There is a shift going on. Even the conversations that I'm having, it's one of the nice things about the kiddo playing with a team that has kids from all over the country is that you just get different perspectives, and they all know that I'm in real estate. So like, hey, how's the market? What's going on? Hey, have you seen this? So it's really fascinating conversations. And we were able to meet up with some friends that we haven't seen in years because they've moved on, and we're having conversations about real estate. So really interesting to get their perspective on what's happening with their market, and even areas that historically have been outperforming the entire nation, the Midwest, the Northeast. Guess what I'm hearing from them? I'm hearing, Dan, you cannot imagine the amount of inventory that we're seeing in our area. And these are folks from the Northeast, from the Midwest. So there's a national mood shift that is going on related to real estate. Here's the good news for Austin. We've been here now for 3 years, going on almost 4 years. May, June, July of 2022 is when we noticed, hey, something's going on here. And this is the journey that we've been. And we've, of course, already noticed a significant correction within our market. And yet we're starting to notice some really amazing affordability indicators to where I am convinced that we are 85, 90% there. And then we are going to be one of the first markets to start recovering because of the affordability factor. There's only one thing I care about, and that is the median sold price to income ratio. I published an article last week talking about that ratio, and it's really amazing to see how far that ratio has gone down, especially when you look at where it peaked and where we are compared to historical averages. Matter of fact, before we start the new listing to pending ratio, let's go ahead and take a look at this really quick. Austin housing affordability returns to 2015 levels as price to income ratio falls to 3.89. And take a look at this. This is using the median sold price for the month of November. This is the month of November snapshot. The median sold price divided by the household income in our area came in at 3.89 for the month of November. Exactly the same ratio as 2015. Now, take a look at something here. It went down to 3.71 by 2019. Not many people realize this. We were in a mini bubble back in 2015-16 that was correcting. Prices were actually retreating, and it would have kept on going down into the 3.54 range had it not been for COVID, had it not been for the Fed reducing rates, making mortgages super affordable. That caused prices to skyrocket. Of course, we all know that. But now we're back to 2015 levels. Now, this is for the month of November. So let's take a look at the entire chart. We're at 3.89. This is going to be the best November. That's going to be the median sold price to income ratio, best November going all the way back to 2019. But then you ask me, well, it just doesn't make any sense. Well, how come pricing is still high? How come people are saying that Austin real estate is so unaffordable? Well, this line has plummeted. Let me go ahead and click on the affordability and show you. That line has dropped. It has plummeted. Let's pull this up. This is going to be that entire affordability. I'm going to skip a few and then go back to it. So here's that line. Look at this right here. This is that line. So right now, we're only 3.95% overvalued when you look at the entire 25-year average of 3.74. Only 3.74. That's 3.74, and we're 3.95% overvalued. We all know that real estate markets tend to overcorrect, so we can expect what? Maybe a 8%, 8 to 12% additional pressure on pricing. That, and you can see, take a look at this. Here's that little mini bubble. And here's the correction that we were already experiencing. The market was correcting. Here we've got 3 years in a row, and then it hits that median or that average ratio. And of course, we've got this entire nonsense that I wish had never happened, but it did happen. So now we're correcting from this. But we're back to just about the 25-year average, which does take into account this. That's why, even though you see that number 3.95% overvalued, I do think that we're going to correct a little bit more than that, because we're going to get back to what level? What level do I think that we're going to return to? I'd say that we're going to return to right around the 2013 to 14 level when you look at this ratio when it's all said and done. And the reason I say that is because of the second chart on this affordability. Because the median sold price to income ratio is going down, but is your PITI going down? No, it's not. Why is that? Well, because of rates. That's why. So it's still not affordable when you look at the PITI, but when you look at the median sold price to income ratio, it's actually quite affordable, back to 2015 levels. And when I share this with people, they're shocked. They're like, whoa, well, wait a second here. But so how come the market isn't just booming? Because of the monthly payment, because of the PITI, because rates are still too high. Now, they are market rates, but they are still high, therefore causing that PITI just to be elevated. The PITI for November, 3,152, whereas in 2015, it was 1,682. So it was half. The ratio was the same, but your monthly payment is double. Well, what corrects this? A lower rate. And Violet said insurance too. Absolutely. Insurance, property taxes, HOAs are up. All of that combined is just cause. As a matter of fact, Violet, you bring us up such a good point. Back in 2015, the percentage that we used for insurance was 0.55%. It was 0.55% of the value of the asset. That was the rate. Right now, it's 0.68. And if you were in the team meeting when Paul Guerrero came over, I said, hey, Paul, are we to the point right now where I have to bump that up to 0.75? And his response was, not yet. Let's talk next year. It wasn't, now, Dan, come on now. It was not yet. That was his response. Because what they're doing is, instead of increasing the rates, which they're still doing, like something like 10% a year, it's insane, they're actually doubling the out-of-pocket. That's what they're doing. They're doubling the deductible. Many policies right now will have the 2% deductible instead of the 1% deductible. So when you have a roof claim and it's now a 2% deductible on a $500,000 property, that's $10,000 deductible. You're basically self-insured. You are paying for most of what could go wrong on your property. It's the catastrophic insurance, very similar to healthcare, right? My personal healthcare policy, the family deductible is some insane amount, like $26,000, but at least I only pay $1,000 a month for that crappy policy. Well, so what do? Last time the kiddo needed an x-ray, I told the doctor, hey, if I pay cash, what's it going to be? And my cash payment was actually cheaper than if the insurance company would have covered it. So I'm like, forget about it. Don't even run my insurance. I'll just pay cash. Ridiculous. The same thing is happening with homeowners insurance. That's why we're not at the 0.75%. We're still at the 0.68%. So I'd say within the next 2 years, we're going to be at that 0.75%. Now, this is a very important week for rates, and we're going to talk about rates a little bit later on, but huge week for rates. You can see behind me that we're really not starting the week that great. On Friday, we crossed a repricing line. Today, we're already up 4.5 basis points on the 10-year Treasury. We are now inching our way towards another repricing line, even with the Fed saying, hey, we're going to cut rates. So I want to remind you that the Fed cutting rates has nothing to do with mortgage rates. Nothing to do. Over time, we all hope that as the Fed cuts rates, that it'll affect the entire yield curve, that everything will then go down over time. But the market has already pre-positioned itself. The market is already expecting the Fed to cut rates. Market's expecting the Fed to cut, 50 basis points. We'll see what happens. Right now, there's a little bit of anxiety, like, well, what if they don't cut 50? What if they cut 25 basis points? Very erratic right now when you look at the market and how they are processing what's going to happen on Wednesday. We're going to talk a lot about what's going to happen this week. Huge week for rates. But we're going to start by updating the new listing to pending ratio. 2,973 open houses were held. Is that right? Open houses or open homes? I don't know. I can never get that grammar correct. I'm terrible with grammar. That's why I love ChatGPT. Terrible. What is that? Open houses? Is there like that? Well, I don't even know how to call it, but that's right. You know what I'm talking about. So we had a little bit of an increase, actually quite a bit of an increase, but of course, before that was Thanksgiving week, so that is understandable. Let us start looking at the number of new listings, and this is going to be residential. Keep in mind, this is going to be for the 6-county area, Travis, Williamson, Bastrop, Burnett, Caldwell, along with Hayes County, from the 1st all the way to the 8th. And so far, 600, and let's go take a look at it, 638 new listings already. That field is going to lock in at 11:59 p.m. tonight. So when you wake up in the morning after a great night's sleep and you look at my update for the new listing to pending ratio, you will have the latest and greatest price increases. Oh, 247. There's that builders getting very confident. End of the year, prices are going up. If you don't sign a contract right now, prices are going to go up next year. That's what they're doing. We don't fall for that garbage. We've got 1633 price decreases, 87%. That's going to be the best number going all the way back to, well, it matches September 15th at 87%. So it's a low number based on what we've experienced over the past 4 years. Back on the market, 175, 27% back on the market. Pretty high number back on the market. Really high number. Active under contract, 265. And pending. You get to guess. How many pendings? We need 5 guesses. We need 5 guesses on how many pendings We've got 191, Melanie Price. We've got Ryan at a very, very bullish 405. Okay, we've got 2 down. We've got 3 to go. Let's go ahead. 2 down, 3 to go. 2 down, 3 to go. 191, 405. We need 3 more guesses. We've got Sonia, 222. I love it. We've got 230, Aaron. Good stuff. We've got 4 down, 1 to go. We need 1 brave soul to make a prediction. We've got Aiden at 200 or 325. Good stuff. Let's go ahead and click on it. We have, starts with a 2. 2, 1, 4. 214 pendings. 214 pendings. Not the best. Not the best. We are starting off at a 0.59 ratio. 0.59. We ended last week at a 0.99 ratio. Week before that, 0.91. Let's do some comparison. Really interesting. Let's focus right here. You notice a little pattern going on? We had a 10.2 year-over-year increase in new listings. Then we had a 17.9 year-over-year increase in new listings 2 weeks ago. That's big. It's a big number. 17.9 increase in new listings entering the market. It was really low at the beginning of the week, wasn't it? Yeah, it really was. You're absolutely right. We had 55 more price increases, 338 more price drops. That was 2 weeks ago. 15 more back on the market. Here's the good news. 3 more active under contract. Here's the bad news. 91 less pendings. So 2 weeks ago, we had 88 less properties go under contract. That number is going to improve a little bit. It's going to stay right around the 70 or so, 70 negative. We're going to see more pendings get updated on the MLS. But look at the ratio comparison. So the overall difference is that 3 weeks ago, we had 7.2 less pendings compared to last year. 2 weeks ago, we had 11.5% less pendings compared to what? Compared to a year ago, which meant that the ratio 3 weeks ago was 0.91 versus 1.07. 2 weeks ago, the ratio was 0.99 versus 1.3. That's a big difference. That's a 30% drop in the ratio. That's a huge difference. And then so far this week, we are down 43.4% on pendings. We're down 19.5% on on new listings. We're going to be negative. It's 10:21 a.m. I do not foresee another 155 new listings enter the market between now and 11:59 p.m. No way it's going to happen. So we are going to be negative on new listings. It's going to be single digit. I don't even think we're going to get 100. So we're going to be negative anywhere from 60 to 70 new listings. So if we do negative 70, that's going to be 8%. So we're going to be down roughly 8% on new listings. We're going to be negative double digits on pendings. And the double digit negative on pendings is actually going to be higher than the single digit negative on new listings. And then you add the back on the markets. Those back on the markets are actually going up. We're noticing a lot more back on the market. Look at that, 19, and it's only 10:22. That number is going to go up. It's going to lock in at 11:59 p.m. tonight, but we are already higher than we've been over the past 3 weeks. Huge back on the market right there, plus 60 year over year. It's a big difference. So we've been positive on back on the market going back now 8 weeks in a row. Sonia said, buyers are coming back. They are taking their time. That is a very good point, Sonia, and I'm so glad you brought that up. I cannot begin to tell you the number of agents. I was like, Dan, I am busy. I've got a lot going on. I'm fielding a lot of phone calls. I've got a lot of people that are what? There's 3 things that buyers need to be: ready, willing, and able. and they are, I'd say, ready. They're certainly able. They're qualified. Are they willing? Are they willing? They're ready. They're looking. I mean, our web stats are just killing it. Remember at the beginning of the year, I had a goal on how many impressions we would get on teamprice.com. Remember what that goal was? It started with 2 million. I was like, hey, I want to get 2 million impressions on our website for the entire year. Remember? And then we hit that number really early on. I was like, okay, I'm going to go for 3 million. And then someone's like, come on now, get aggressive, go for 4 million. I was like, oh, well, can't let them down. Then I was like, okay, well, let's go for 4 million. Let's go for 4 million. Y'all, we are at 5.5. 5.5 million impressions, 54,000 people acted on that impression. And take a look at the top queries, right? Team Price Real Estate, Team Price, Housing Market Prediction, Austin Housing Market Forecast, Austin Housing Market, Austin Real Estate, Austin Housing Market Prediction, Austin Housing Market Crash, Forecast, Market. We got a few TXR forms. Prediction. Will the housing market crash in 2026? Austin Real Estate Crash. I mean, those are like a lot of the keywords. Aaron Dunnigan. There you go, Aaron. That's what I'm talking about. So those are all the things that people are really curious about. And what does it tell us? Yeah, it's that hesitancy. It's like, hey, I'm ready. I'm certainly able, but am I willing to pull the trigger right now because I think that the market might correct further? How do you combat that? Well, one is you're honest. Yeah, you're honest. Honesty. Hey, what do you think is going to happen in 2026? Hey, we're noticing a lot of pressure on pricing. When you look at all the data, I can absolutely see where the market corrects another, 5, possibly 10%. In saying that, we're down 22%. In some zip codes, we're down 35%. So there are some amazing opportunities right now. And if you see something that you like, let's negotiate an 8% price drop right now. Be ahead of the market. So those are really good conversations to have. But if the person says, you know what, I'm just not feeling it, I'm just going to wait a little bit. I think that 2026 is going to be a year where rates are going to go down and then prices are going to go down. And I feel like I'm going to get a better deal in 2026 compared to 2025. Say, hey, I plan on being in business. I'm going to be here. Stack your pipeline. Keep on providing that client with that substantial, good quality information. If they feel like they are your next paycheck, they're just going to call someone else. So don't ever go down that. Does it mean you're going to have to hustle between now and then? You better believe it. Absolutely. But this is not an easy market. But y'all, this is where character is built. And this is where the diligent will thrive and the lazy will get decimated and will get slaughtered. And those who are left will reap the spoils of war. I don't know. You ask, I love it. I love it. I just hope someone just doesn't clip this one little part of what I'm saying and then I just get canceled for any reason. But I'm willing to take the risk. I'll say that. Charmaine was smiling when I was saying it, so it was worth it right there. So if I get canceled, I'm doing a screenshot of Charmaine smiling, and Charmaine's going to get canceled with me. Because if I go down, I'm going to take as many people with me as I can. That's my policy. Right, Charmaine? Give me a thumbs up. Hey, look at that. She gave me a thumbs up even before I said give me a thumbs up. Love it. So there we are. That's where we are when it comes to pendings. That's where we are when we look at the comparison. Really interesting. Now, I have not updated the monthly for December quite yet because the weekly is December. The weekly is December 1st through December 8th. So why would I update the monthly when the weekly is the month of December? But I did update all of the previous. Also, all of November is the latest and greatest. And where are we when you look at the year over year for November? A few things that we can really glean here and pay attention to. We've got 11.7% year over year increase on the number of active listings. Let me make this a little bit bigger for some of our amazing elder agents. So a little bit bigger for you all. You're welcome. 11.7% active increase year over year for the 6-county area. Keep that in mind. We also have it for the entire MLS. This is for the 6-county area. Here's the interesting thing. 60 less new listings. 60 less. But the previous month, 330 more. So a 2.2% decrease on the number of new listings entering the market for the month of November. Price increase, plus 20. Price decrease. Y'all, we have been on a plus on more price decreases for 12 straight months. Not just a little bit more. 14,504 more price increases this year compared to last year. 14,504. Crazy. What about price increase? 518 more price increases. But don't pay attention to these price increase nonsense. That's builders 1983 sales tactic. We're going to raise our prices, and then we see the prices going down. So that's just a bunch of garbage. Active under contract, plus 72. Here's the good news. Month over month on active under contract, we've been up for 7 straight months on active under contract month over month. On pending, we've had a few positive months. When you add everything, active under contract, 535 on the plus. But on the pending, we're 859 on the negative. So when you add all those together, we're 324 on the negative. So we are really outperforming the active under contract. We're underperforming the pending. Well, now it makes sense. Why is back on the market up by 38 year over year? Why would someone leave it active under contract as opposed to going pending? So there are a few things going on here. One is we're noticing more and more properties that will be active under contract with a contingency. Okay, so we've got active under contract with a contingency. We've got 86 right now. 86 properties are active under contract with a contingency. If I were to rewind 5 years ago, no, not 5 years ago, 4 years ago, 3 years ago, you know what that number was? Single digit, under 10. Well, now we've got 86. Still not a huge amount, but it's a pretty high number. And of course, if that property that they're hoping to sell to then purchase the new one doesn't sell, the property comes back on the market active. So sellers are really hesitant right now to change over their listing to pending. They're going to ride that active under contract for as long as they possibly can. When we go back to 2022, 2021, or let's take a look at that, this negatives. This is the year over year. This is 2022, 2021. If I go 2022, look at this. We had obviously the year over year drop. So let's go back to 2019. That's when the market really started picking up. Look at the number of active under contract versus pending. More active under contract, but then it switches. More pending, way more pending, more pending, more pending. More pending, more pending. So we've got a stretch right here where pendings just went sky high in relation to the active under contract. You know what that tells me? Healthy contract. Very few contingencies, low option period, where the seller's like, yeah, this deal is going to go through. It's not going to fall apart. I don't want more showings on my property. Just put it pending. Don't make the property available to anyone else. The higher the pending, the more confident the seller is that offer is going to stick, the lower you're going to see the back on the market. Now, there is a transition period on back on the market to where if a buyer is submitting multiple offers, 4 or 5 offers, the back on the market will actually increase because they're terminating the 2 other offers. That's not a real back on the market. it still shows up on the data. So you have to really hyper analyze, why are things coming back on the market? Right now, things are coming back on the market, not because the buyer's submitting 2-3 offers. Number one reason why things are coming back on the market is financing. And it's going to be the combination of the property approval and the buyer approval. So this is my warning for you all. We are officially in the stage where properties are starting not to appraise. Last week, I had 2 conversations with agents where the property did not appraise. So be on the lookout for that. Listing agents, how do you address that? Well, you do the appraisal package. You go to resources. You search appraisal package. You treat the appraiser like a showing. The second the property goes under contract, you change the status. Instead of schedule an appointment through showing time with a seller, you say schedule with agent. Heck, you remove the daggone lockbox from the property. And then when the appraiser gives you a call, you schedule the appointment with the appraiser. You get to the house 15 to 20 minutes before, and you turn on all the lights. You make the house comfortable. You get your carpet rake. You can Google that. And you rake the carpet to make it look really pretty and really nice. You light up the nice candle from... What's the best place? Anthropology, man. Anthropology has the best scented candles in the entire world. That thing smells so good. You could eat it. That's how good it smells. But you treat the appraiser like a buyer. Do you think it matters? Do you think it makes a difference? You better believe it does. The appraiser walks into the home and everything is nice and clean and the lights are on, and you hand over an appraisal package if it supports, and just make it really nice and presentable. That will affect the value. I guarantee you it does. They're human beings also. There's a reason appraisal values don't have to be disclosed, because it's not a material fact. It's an opinion. Does that mean that you can influence that opinion? You darn right you can. Absolutely you can influence that opinion. So that's why we're noticing pendings backtracking, but yet active under contingent actually increasing. It shows that there's less confidence on that transaction. It could very well fall through. Then we've got the sold, and sold's been tough. 16% drop in sold year over year. That is going to mark the worst year-over-year drop in sold since September of 2023 compared to September of 2022. So we've got the worst drop on sold in 27 months. That's a big deal. That's a really big deal. Why are we noticing such a big drop on sold when the previous month we had an increase in active under contract, and over the past 7 months, 5 out of the 7, we outperformed pendings? So then why, or outperformed the previous year on properties under contract, then why the heck do we have such a massive drop in sold? Because of what's going under contract. Over the past 4 or 5 months, the activity index for new construction is really pulling ahead of the activity index on resale. So more new construction properties are going pending. Well, those take longer to close. So they're not showing right here on that immediate close. Resale closes in 30 to 45 days. New construction, yeah, of course, some of them will close within that time frame, especially if they're ready. Builder really wants to go to escrow. But you've got a big chunk of new construction that is pushed out 60 to 90 days. And that's why we're noticing a drop in that entire sold. Because this increase, especially July, going into August, and then October, a lot of those pendings were new construction. It's weighted more towards new construction, which is going to cause the sold to backtrack a little bit because it's going to be pushed away a few months. So keep that in mind. Of course, we've got a huge increase on the number of quits. Withdrawns and expired. really, really big. We've got an additional 3,107. An additional 3,107 withdrawn and expired. A total of 18,076. Man, just let that sink in. 18,076 withdrawn and expired. Let me go ahead and close this really quick. Let's get this window up. I need to go ahead and just move to my other computer. Just give me 1 second so that I can open up the new listen to pending ratio and actually publish it as a PDF. I like to do this live right here in front of you so that you can access the entire new information as fast as possible. We're going to get this published. It's just going to take me 2 seconds to convert this to a PDF. Okay, we've done that. And then I'm going to upload it to the teamprice.com. I just need to right click one more thing. And now that I went ahead and copied that, we can go back to Insight and Statistics. And okay, we are there. So now I can click on new listen to pending ratio. And there you have it. It is fully updated. We've got the complete updated new listen to pending ratio here. And now we can just take a look at a few other things that are very noteworthy. Okay, we've updated all this. We know all this information. Let's take a look at some of the monthly really quick. Difference between new and pending. 227 for the month of November. Next week, we're going to have the December, the month to date on December. We've got 6,000 will relist in the spring. I agree with you, Melanie. I completely agree. That's right around that 30% or so range. I agree completely. I am expecting 6,000 of those 18,000 to be relisted between January and May. The more I analyze this data, the more I am convinced that we're going to hit that 20,000 active listings somewhere around, say, May to June timeframe. We're going to officially crack the 20,000 active listing mark. I am personally convinced of that. Let's take a look. I'm going to highlight all of the months where the difference between the new to pending exceeded the previous year. So we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. So we've got 9 out of the 11. The difference between new and pending actually exceeded last year. So we still are experiencing an inventory buildup. And we can see, what about the new listen to pending ratio? How many months this year exceeded last year? We've got August, it exceeded. We've got June, it exceeded. And that's it. We've got 2 months where the monthly ratio this year exceeded last year. We've got August, this year 0.8, last year 0.75. June, this year 0.72, last year 0.71. We're getting really close in the month of November. I'd say we're going to match it, but we're not going to exceed it. And so far, it's not looking promising for December. I do not think we're going to exceed 1.03 as of now. I hope we do, but on a monthly basis, I do not think that we're going to exceed that. And the reason I bring that up is because of this. This is not a chart that I publish. I just look at this for my own use. And I don't publish this chart because I haven't figured out a decent way to actually display it. But this is what I do. Yeah, it's just really crappy way to display it. Let me make this a little bit, not that small. Let's make it just a tiny bit. Okay, so there we have it. Let me just, so this is the week over week. We got 2021, 22, 23, 24, 25, 52 weeks out of the year. And I can make this graph a little bit bigger so you can actually see it just a little bit more. Okay, there we have it. That's why I don't like publishing this one. I like looking at it. I don't like publishing it. This looks like it's totally not useful, but it really is. So here we've got 0.59 so far this week. That's going to increase. We know it's going to increase. Is it going to be 0.89? No, absolutely not. There's no way it's going to be 0.89. Now, 2 weeks ago, 0.99, the previous year was 1.3. But here's the good news. It beat 2023 and it beat 2022. I'll take that all day long. Previous week, 0.91, did not beat the previous few years. This one beat. This one beat. So it's really just either it matches really closely, kind of beats it a little bit. But overall, take a look at 2025. This is going to be that orange. And I can even make this orange just a little bit bigger so that now I want to do the entire orange. Let's change this to 5 points. Okay, there's that orange. Makes it a little bit better. And look at the orange. We're just hovering right there. Of course, we've got a higher ratio at the beginning of the year because less people put their homes on the market the first week of the year. That's why the ratio goes up. And then end of the year, the same thing happens. But we are stuck. If you look at the weekly ratio the entire year, we're averaging 0.8, whereas in 2024, we were averaging 0.86, 2023, 0.71. And right now we're what? We're 0.8. So we're outperforming on the weekly basis. Oh, no, 0.9. I'm sorry, 0.9. Let me do this. AVG, and then I'll also do median. So equals average. Let me get all of this. So we went from 1.27, 0.97, 0.90, 0.86, 0.8. Let me now do the median. Equals median. And let's just highlight all of this. And 1.26, 0.85. Let me make this a little bit bigger. 1.26, 0.85, 0.87, improving. 0.84, a little bit of a backtrack, 0.79. So we're ending the year both on the average and on the median underperforming on the average the previous 4 years. I'm more so looking at the last year and 2023. So we're underperforming 2023 and 24. On the median, we are also, of course, underperforming everything. We did have an improvement in 2023 compared to 2022 and 2024, but here's that 0.79. And you can see that the ratio is actually redder at the beginning part of the season, whereas we used to see the ratio turn. See how it's turning there, kind of turned right here. Now it's turning here, little bit more red here. So why do we see that? Well, because by week 13 to week 18, and what is that? Week 13 to week 18 is what? 4 weeks in a month. That's by March, April timeframe. The market is flooded with inventory. It's an early selling cycle. More people are putting homes on the market earlier. That's what's happening. That's why we see this ratio turning red earlier, because now a lot of the sellers, a lot of the agents are saying, I want to be first on the market. And then the market just has that really big increase in listings. Violet just posted a link to an article, Realtor.com article. Delistings, right? These are the quits. Surge as frustrated sellers pull back, and 3 pandemic boomtowns are getting hit the hardest. Do they have Austin here? Let me go ahead and just do a search. And we've got Austin. Where's Austin? Where's Austin here? Do they have Austin here? It says 19 out of 20, but I can't find it where they have Austin. Yeah, crazy. And that's exactly what we're noticing. More and more quits. More and more quits happening right now. We got Miami, Denver, Houston, LA, Riverside. A lot of quits. We're certainly experiencing that. Austin is on the ads. Oh, there you go. Thank you, Sonia. So I don't publish this one. Happy to review this whenever we meet up on a Monday morning touch point, but I just haven't figured out a really good way to publish this specific chart where someone can just look at it, read a headline, and be able to understand it. So this is going to be internal to us. This is going to be more family business as opposed to something that I feel comfortable publishing, which, is one of the benefits of being a part of the Team Price inner circle here, is where, we can discuss this information that no one else has access to. Let's go ahead and take a look at the Austin daily briefing. Anyone here woke up this morning after an amazing night's sleep and did your prayer meditation, did your routine, and then took a look at the Austin briefing? Anyone here? Well, add that to your daily. Add that to your Kickstart Your Day. We do have a really good Kickstart Your Day. And pick a number to memorize and then use that number to have a really good conversation with people. So we've got 14,426. We're plus 14.1% year over year. On pendings, we're negative 0.5. There's the active listings. Of course, you know that we peaked on June 30th at 18,146. We're at 14,426, so we're down 3,720. And we can see a little bit of an increase right there on the number of active listings. It's going to be really interesting to see how the year ends compared to last year. This number went up a little bit. On Friday, it was 57.2%. It's 57.5% of all active listings have had at least one price drop. We are up 14.1% on the number of active listings. Of course, we've got a 25-year record high on the cumulative number of active listings. Keep in mind that this does not include the month of December quite yet. Next week, this will include the month of December, and then we'll write out all of December looking at December. But we did experience a 5.5% increase year over year on the cumulative new listings from January to November. Pending, this does include today's pending. We are currently at 3,764. Last year, this same day last year, 3,782. So we are officially underperforming last year on the number of pending properties. We're down by only 0.5%, but I was really hoping to see a positive number there. When you look at the cumulative number of pendings, man, the market is stuck. Look at that. The market is stuck. We're at that 40,900, 41,400, 41,100. Good news is that this year we are outperforming 2023, also known as the year of misery. We are underperforming last year, but we're not overperforming the year of misery by much. Not at all. The market is stuck at this right here, which is really interesting. Good news is that it is above the historical average, but then we have to do what? We have to adjust it by population, right? When we adjust it by population, that's a whole different story. Let me go ahead and just get this over. Let's take a look really quick at the new listing to pending ratio really quick and do the adjusted for population. Give me 1 second so I can pull this up. Here's the new listing to pending ratio. Let me adjust this for population. Let me open this up for you. And let's adjust this for population. We've got new, we've got pending, cumulative pending, and now let's adjust it for population. Non-adjusted for population, we are up. Adjusted for population, which you really have to do, we're down. I mean, we're 19.9% down, and we're just stuck right there, 109, 111, 122, 116. Just not going up. Cumulative, everything that went pending from January to November, 1609. Only 1 year underperforms us, and that's going to be 2010 at 1604. Wow. Crazy. So we're down 3% adjusted for population because our area's population actually did go up. Really crazy. Let me go back to the daily activity index. Take a look at that new construction versus resale. 27.67. Good news on the resale is that we did get down to the 16.75% activity index on resale. So that had a nice little bump up to 17.51. But look at this. We've got 2023. The sucker kept on going down, bounced up in November. 2024, down, bounced up in August. A little bit flatter, of course, not as much as 2023. 2025, it bottoms out when? Towards the beginning of July. And it's not going up. It's at best flat with a slight downward pressure on that activity index. So we're not noticing that bounce up on the activity index. It's just staying flat, which means that the buyers are out there. And like Sonia said earlier, they're just hesitant. Stuff is still going under contract. It's taking longer for it to go into contract. Days on the market just exploding. So properties are staying in the market longer. But in relation to inventory, that's what I love about the activity index. It's always related to the inventory. We are stuck. We're stuck right around that 20% activity index. You know that 20% activity index is known as what? This line. Let me try to draw it as straight as possible. That's not bad. That is what I call the danger zone. That's the danger zone. Okay, and you can see that we are just right there on that danger zone. So something to be on the lookout for. That's why I trust this information. And of course, we update this information on a daily basis. Well, let's take a look at the activity index on the resale side for zip codes. Number one zip code 26, killing it at 41.3% activity index. We have 3 zip codes in expansion, 6 in equilibrium, 21 softening, 28 in the danger zone between 15 and 20%, and 17 downright crisis and freeze. Had a team price agent reach out to me over the weekend like, Dan, I don't understand. Put this listing on the market. I'm not getting anything. What the heck is going on? I pull up the activity index. It's like, bud, like your zip code is like, it was something like 12% activity index. Like it was one of these right here. That one actually increased. Mike, yeah. I mean, which means out of 100 properties, 12 are pending, like roughly 12 are pending. Like there's just not enough buyers. No, you've got to be so exceptional and so price right. You're not going to get a showing. You might go a month, 2-3 months without even a showing. Oh, but by open house, no one showed up. Well, yeah, there were 20 other open houses. Nothing stands out. Got to be aggressive on the pricing. That's all. Well, my seller doesn't want to go down. Okay, well then fine. I mean, what do you want me to say? I mean, it is what it is. We've got new listing to pending ratio. There's that current at 0.93. This is for the month. We'll update December next week. There's that 0.93, slightly lower than the previous year. And let's take a look at some months of inventory. That is stabilizing right there. We're at 5.15 months of inventory as opposed to 4.64 for the previous year. And what are we looking at on months of inventory? 4.9. Unbelievable. Only 2 months of inventory. Doing really well. 2.8. 2.08 months of inventory. 3.9. 2.17. Really incredible. Some of these have very low inventory. But we do have, what's 17 plus 15? That's 32. We've got 32% of the market is in full-blown buyer advantage, buyer control. A third of the market, the buyer has an advantage. a quarter of the market, it's a toss-up. It's going to be that neutral zone. A property that is priced right may even get multiple offers. A property that's slightly overpriced, you're in no man's land. And then you've got a seller-accelerated market and a seller-edge market. That's a significant portion. 25 plus 19, that's what, 44? So you got 44 zip codes, 44% of zip codes that, or is that more than that? So 25, 19. So 44. So you got 44% of zip codes. The seller still holds some advantage. That's where you have to look at individual price points and then the activity index and months of inventory within those price points. Months of inventory, lagging market indicator. This number can be very deceptive in the month of December. Why is that? You've got a lot of quits. So you take a zip code and let's take a look. Really want us to understand this data. So let's really dissect this. Let's go activity index zip code and let me find the resource that I want to focus on right here. This is the resource that I want to focus on. And what I want to do is I want to pick this price point. Just takes 2 seconds. My eyeball goes straight there, right here. The $500,000 to $600,000 price point in the 78759 zip code. Even the 300 to 400. This is very deceptive because you have the leading indicator is red. That's going to be the active divided by, or the pending divided by pending plus active, right? Pending divided by pending plus active, that's going to be your activity index. That's really low. That's danger zone. Months of inventory, not bad, 4.8 and 4. That's the lagging indicator. This is what happens. The market hits a wall. All of a sudden, you've got a decrease in pendings, a decrease in showings. So then the seller says, you know what? It's November, it's December, Thanksgiving, get the property off the market, get rid of the property. But the market just stalled like over the past 2 weeks. And that happens. All of a sudden, activity just drops. Seller gets really frustrated. So then they take the property off the market. The active listings go down, sometimes by 20% within a 2-week period. But you still have those pendings. So what happens with the activity index in that case? Well, the activity index could actually, if you've got less active, same number of pendings, the activity index could actually improve. The activity index could actually go up. So that's something to be on the lookout for. But then you also have a situation where the sellers all of a sudden do what? They take their homes off the market, but you also have a collapse in pendings. That's the case with 5.8. You've got a decrease in inventory, but also a dramatic decrease in pending. So the activity index goes red. That's at 19. That's at 16. But why is months of inventory at 4.8, 4.0? Because you had a really good past 3 months. You had really good activity over the past 6 months. So what is this? This is December. Go back to June. June, really good activity. A lot of properties went pending. And then they closed when? July, August. So you've got August, September, October closings that are affecting the months of inventory. You've got a high number of closings, and then you've got less active inventory because of quits. What are you going to have? Low months of inventory. But then when you match that with the activity index, you're like, hey, that low months of inventory is really deceptive because at a 19, 16%, you ought to have a little bit more inventory. Take a look at this one. 17%, 45. It's not going to get up to 45, but the months of inventory at 16% shouldn't be 4. It should be what? It should be 6, 7 months of inventory. And that will happen. That will happen. It's the difference between the lagging indicator and the leading indicator. Really important for us to understand that. Take a look at the months of inventory year over year. City of Austin is up 13.1%. Let's take a look really quick on months of inventory for zip codes. 05 up 140%. 78753 up 117% year over year. That's a lot. It's a big difference. We went from 4.2 months of inventory to 10 in 78705. That is crazy. That's insane. And look at the price breakdown. Oh, just brutal. Between $300,000 and $400,000, you got 21 months of inventory between 750 and 1,000 square feet. Crazy, crazy high inventory right there. Let's go back to year-to-date. City of Austin is up 5.3%. We had 1,976 sales last month. Next week, we're going to have the update so far for December, our projection. When you index that to population, 1,082. So good news is that we're not the worst year on record. We're the third worst year on record. When you adjust it for the number of agents, this isn't bad, 1,497. So we outperformed 2024. We outperformed 2023. We outperform, that's it. So 23 and 24. Those are the only 2 months that we outperformed. That's crazy. So when you look at the cumulative sold properties from January to November and you divide it by 1,000 agents, we're actually even under 2008, 9, and 10. That's kind of scary, isn't it? That's crazy. Sold. What about sold? What's going on with sold? We had an increase in the average sold price by 2.1% year over year. On the median price, we're down 0.9% year over year. So on the median price, we're back to 428 for the month of November. That's going to put us at that 22.16% drop. What about the percentile analysis? Past 30 days compared to the same period last year. Bottom 25th percentile, we are down 1% on price, 2.7% on price per foot. On the top 25th percentile, we're positive on both, but we're only positive by 1% on price and 0.4% on price per foot. Still, we've had 9 cities that the median price so far this year is higher than last year. So now let's take a look at the absorption rate. Sold divided by active, 15.4. When we take everything that's sold and we divide it by everything that's active, we're going to get a 15.4% absorption rate. And that right there, my beautiful people, is going to be the lowest one going all the way back to February of 2011. What does this tell us? Inventory is still high. There's no, when you hear the insane politicians talking about, even within the city of Austin, we've got a housing crisis. No, we don't. No, we don't. We got certainly an affordability crisis. Okay, January 2012. Oh, yeah, there we go. Thank you. Eagle Eye, Aaron. That's what I'm talking about. 15.2. So we have to go back to January 2012, 15.2. We're at 15.4. But no, we don't have an inventory problem at all, especially with the multifamily. And we have not seen the end of multifamily. Still a lot of pricing pressure within multifamily. Prices are down insane. I did publish an article on just what's happening with multifamily. Let's see if we can find this really quick. Suburbs, rent decline. Here's the article. Yeah, take a look at that. Here we've got, this is in the nation, by the way, in the nation, 200 and some cities. And when you look at every single city in the nation, number one for multifamily rent price drop is Round Rock at 22.29% drop from peak. Then Georgetown, then Leander, then Pflugerville, number 5, Austin, number 6, Cedar Park, number 7. So out of the top 10 markets, out of over 200 markets in the nation, we've got 6 out of the top 10 are in our area. And I expect when this is all said and done, when you look at permits, when you look at multifamily permits, I expect Round Rock, when it's all said and done, to be down 30 to 35%. So we're not done with that multifamily. With that pressure on multifamily, you then have pressure on single family. See, 2008 was more of a single family residential crisis. This crisis right now is going to be more of a multifamily crisis that affects the single family. Why in the world would I buy that at 3,300 where I can rent that apartment complex? And because we have a high millennial population, we've got a lot of young people in the area that for the most part are being very wise with their money. They're saying, I'm just going to save it. I'm just going to save my money. I'm going to enjoy lifestyle more than real estate. And I'm just going to save right now. And I'm not going to buy that $1 million property and pay that crazy PITI. I'll just rent for another year. So there is a pullback on that resale, even new construction, because they're seeing such value within multifamily. And some of these multifamily, they're borderline resorts. They've got the gym, they've got the swimming pool. So a lot of pressure on multifamily that is absolutely impacting the resale side of things. Market flow score. This is where we rate the market between 0 and 10. I've got really good news for you. This improved. We're at 5.36. And the previous month was 4.84. We are still lagging last year. We do tend to see a bump going towards November and December. This is where we take everything. We take the active to sold ratio. We take the demand velocity. How fast are things selling? What is the market absorbing? What is the turnover rate for real estate? We plot everything and we just say, okay, let's just do a 0 to 10. 0, there is no market. There's no market. We've only had 1 month in the history of Austin real estate where it was 0. That was January 2009. And I was in business then. And that's like nothing. Nothing is going on. You cannot give the sucker away. All the way to 10, which means best of the best. Well, we're right in the middle. We're just at 5.36. That's where we are, right down the middle. Now, we have to go all the way back to 2010 to get a lower number. We're really close to 2009. We're slightly under 2009. So that's the big question that we have. Everyone thought that in 2009 we had a rebound. Market peak 2006. 2007, we started seeing a pullback. Here's that pullback. And then 2008 was brutal going into 2009. And then in the fourth quarter of 2009, we started getting that recovery. And we're like, okay, it was bad, but, wasn't that bad. And then we had 2010. All right. Then it was just like, wake up. That was the phase 2 happened 2010. That was 4 years after the market had already peaked. That was 4 years later. And that's where it was like, because look at the average. Even though the worst month was January 2009, 2 months after Lehman Brothers collapsed, after people, should have gone to jail, never went to jail. They got bailed out, but so be it. We had an average ratio of 3.96, an average ratio of 4.99. So we had isolated pockets of pain, whereas 2010, we had consistent pain. That's the question. That's the hesitation that buyers are having. They might not be able to communicate that. Is 2025 2009? Like close to it. Like, are we going to have phase 2? That's why the narrative is changing. Those are like the articles. Hey, are we going to notice an increase in foreclosure? Are we going to notice an increase in short sale? What if? In 2006 is going to be 2010. That's the question. That is the question. That is the hesitation. Here's my thing. I don't care. I in all honesty, there's nothing that I can do that can influence that. Not a thing. I can adjust. I can outwork. I can outcompete. I can outcommunicate. I can do all of that. I can only control what I do from the moment I wake up to the moment I go to bed, happily exhausted. Would I want it to happen? Of course not. Of course not. Will I adjust? Of course. Will I survive? No. I want to thrive no matter what. No matter what. Just I will never. Only rehab is for quitters. That is my life statement. Only rehab is for quitters. It's a valid hypothesis that 2026 could very well be a repeat of 2010. It's a valid hypothesis. If I had to roll the dice, I would say that I'm 70% yes as opposed to 40% yes. I'm like, wow, everything is really lining up to be very, very similar, especially when you look at the notice of defaults, especially when you look at what's happening within the foreclosure, pre-foreclosure. Let's go to my search right here. Would you like to take a survey? Absolutely not. And then I go to distress sale and I go, not distress sale. I go to foreclosure stage. Because here's a thing that's really interesting. When you look at the MLS, you have 78 short sale, only 2 notice of default, 10 pre-foreclosure, 10 in foreclosure, 9 auction, 4 bankruptcy, 88 real estate owned. So when you add all of it, including probate, that I don't even want to add probate or estate because estate is totally different. Like an estate property is not a distress sale. It's just not. As a matter of fact, you look at the estate, you've got an average price of $586, and then you look at, resale is $706. It's not that much different. I mean, the highest price point is bankruptcy, and then you've got auction, and then you've got estate. So estate outperforms notice of default, short sale, pre-foreclosure, in foreclosure, outperforms real estate owned, outperforms third-party approval. But when you look at everything, 493, let's get rid of 200. So you're at 293, 275. Let's just say 275. You've got 275 active properties on the MLS that are at that kind of critical juncture where there's a notice of default. Now let's take a look at Realist. I'm going to go to pre-foreclosure. And I'm going to go to, let's go to what area? We're going to go, is there a place for county here? Multiple counties selected. Let me try to get the counties. Okay, yeah, we got Bastrop, Bell. Well, we don't want Bell. Man, they keep changing this. It just kind of drives me crazy how they keep changing this. No, I don't want that. Where is it? Okay, so let's go to change county. I'm going to get rid of Bell. So Bastrop, Burnett, Caldwell, Hayes, Travis, Williamson. Good. I'm just going to apply that. So those are going to be my counties. And then we're going to go to my search. And we're going to go to foreclosure stage. I'm going to add these 3. And we're at, let that sink in, 2,290. Do you remember how many the MLS showed? 1/10 of that. The MLS showed 10% of that. Tax record shows 2,290. So what's going to happen to those? Now, some of them are being sold off market, of course, but at one point, even the ones that are not sold off market, they're going to have to hit the MLS. Eventually, they're going to hit the MLS. So there's a lot of pent up, distressed properties that have not hit the market. That's a high number. It's a very, very high number. Foreclosure indicator, yes. We've got how many? Yeah, there you go. 2,290 foreclosure indicator. Yes. Crazy. And how many in the past 3 months? Foreclosure recording date, past 3 months. Oh, out of the 2,290, 748 just happened in the past 3 months. How many in the past month? Let's go to November 8th to December 8th. 285. Really interesting. More properties on tax record were labeled as foreclosure in the past month, in the past 30 days, than there are all active, including real estate owned, including short sale, including all of that in the entire MLS. So there's that hidden distressed inventory that is building up that's not made available for sale yet. Is it going to be made available for sale next year? First quarter 2026, second quarter 2026. That's the big question. That's the big unknown right now. We already noticed a 20% increase in foreclosures? 20% increase in foreclosures. Yeah, there we go. CNBC, new foreclosures jumped 20% in October. This was published November 13th. 20%. Now people, but it's still historically low. It's like, we just can't be like, we just can't put the blinders on, right? Bottom line, we just can't. We just have to be very objective with this and say, okay, interesting. But we also can't be obsessed with it and say, oh my goodness, I'm going to have a horrible 2026. No, we just have to be realistic. Just have to be realistic. That's all it is, right? I always compare the market to the weather. It's like, I don't care what it is. I'm just going to have to dress appropriately. That's what I care about, right? So, we were in Chicago. I knew it was going to be a wind chill factor of 6 degrees. So there you go. I bundled up. Wow, because it was daggone 6-degree wind chill factor. I can't control the weather. I can control what I do in the midst of the weather. Same thing with real estate. All right, you all, really last thing that we're going to do, I know I'm way over time. I do apologize. I know you all have like a lot of stuff to do, but I just kind of got carried away because I miss you all. So let's take a look at a few things. Give me another 60 seconds. And let's take a look at the bond market. Okay, down by 3.9 basis points. So a little bit of a recovery over the past 90 minutes. That's really good. Huge week for rates. Today's going to be all about bond auctions. So we did have a better than expected bond auction. There you go. That's why the rates went down really better than expected. That's encouraging. In 39 minutes, we've got a 3-year auction. Hopefully that performs better than the last auction we had. Tomorrow, National Federation of Independent Business, Small Business Optimism. That's going to come out. I don't know. I don't think that we're going to beat 98.1%. I hope we do. We've got ADP. We've got JOLT. JOLT stands for Job Opening Labor Turnover. That's going to come out at 9 a.m. tomorrow. If it's noteworthy, I'll post something on our Facebook group. A big one's going to be Wednesday. Wednesday is going to be huge. Of course, we've got mortgage applications. I expect that to be positive because rates did go down 6.19. Our area 6.5, but the Fannie Mae 6.19. We've got crude oil inventory. That is very important, 9:30 a.m. That speaks to the health of the economy. If inventory goes up, that means less people are driving. That means less freight. So that's not a good thing for the economy. You actually want crude oil inventory to go down as opposed to going up. But the big one is going to be at 1300 hours, also known as 1 p.m. And that's going to be all about the FOMC. That's going to be the Federal Open Market Committee. They're going to do their dot plot report. They're going to show not only what rates are right now, they are expecting a 25 basis point decrease from 4% to 3.75%. And then they will publish their projection for the next year, 2 years, 3 years, and then long-term rate projection. I'm going to be glued to the MBS trading platform I'm just going to be glued to my computer tomorrow at 1300 hours. And then we've got Thursday. Really, really important day on Thursday, even though they're not showing here on Thursday because something is happening that is off the trading platform. And we're going to go to trading economics for this instead of investing.com because after hours, did they take this out? Maybe they did take this out. They were supposed to publish after hours some of the previous CPI information for the previous few months when the government was actually closed. That's actually going to be published this week. They did remove it from the schedule, but it looks like that will be published sometime this week. So I'll just let you know as soon as they publish that. It was actually supposed to be on kind of Wednesday, Thursday time frame. Let me get the email that I sent you all this morning because I did include it on that email. Let me pull this up right here. And that is scheduled to be published right here on Thursday. So after sometime on Thursday, they removed this from the schedule, so we're just going to have to wait and see whether they're going to update this. But sometime on Thursday, they are supposed to publish some inflation information. And so we've got green, low data risk, more auction focus. Tuesday, a lot of labor information, 10-year Treasury. Wednesday, the most important day, that's going to be the Fed decision, the dot plot. Then you go into Thursday, you've got some inflation and digesting what the Fed actually said. And then on Friday, you've got low data risk, more so on the Fed speakers that are going to be speaking on Friday. And a lot of commodity data is going to be released on Friday. We do have a Wednesday training. We do have a Friday team meeting. Be sure to join us for our Friday team meeting. It's going to be the last meeting of the year. It's going to be at the Austin Board of Realtors. Please be sure to join us for that. Otherwise, you all, this is supposed to be 60 minutes, but we did not meet last Friday, so a lot to go over. Thank you so much for being so generous with your time. Super appreciate it. And if you have any questions, comments, concerns, criticisms, or complaints, please feel free to reach out. Super proud of you all. Could not just pick or hope for a better team to work with. So really proud of you all. Keep up the amazing good work, and I will chat with you later.